Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 25th of November. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about US equities and the recent volatility. And naturally speaking, on volatility, it is quite likely that people will be linking up with portfolio diversifiers, such as gold. Well, gold has been hovering around the 4,100 level. The recent rebound in the middle of November did not get enough momentum in order to challenge the all-time high back in October. Indicators such as the ADX, which measures the strength of the directional momentum index, as well as the relative strength indicator, i.e. the RSI, they did not show much technical conviction on either side. Now, gold is not necessarily going to benefit from equity markets under pressure if that is caused by a tech-led dip or cryptocurrency weaknesses. Margin calls could pressure gold in the short term if equities were to remain under pressure. Tariff uncertainties with the Supreme Court decision lingers, and markets have scaled back expectations of a Fed rate cut in December. Therefore, investor appetite has slowed, and in November, exchange-traded product flows have remained flat. While ETP inflows have slowed, the physical market has not weakened as bad as might have been expected in light of record prices. So it is important to note that the composition of the investor's profile holding shares of the largest US gold ETP has changed. So established holders of gold, such as pension funds, have started to scale back exposure. And that suggests that ETP flows may become more nimble. The positioning is certainly below its peak. But do note that the investment advisor category, which includes some family offices, continue to grow in the third quarter this year. Many new investors are still under-allocated compared to target allocations. So, where do we expect gold to go from here? Well, at this stage, liquidity is the dominant factor in the markets. The expectation of a Fed rate cut in December remains lower than what investors were projecting earlier. So this is sapping investors' liquidity. So it is possible that we will see gold going sideways around the current level until the upcoming FOMC. Then we'll get a clearer picture of the macro path, and gold and other risky assets may start to take off again on sell on rumor, buy the fact dynamics. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.